Good afternoon, everyone, evening or morning, depending on where you're located. Thanks for having us present today. Our company is LNG Energy Group. We are a natural gas production company in where that its main assets are in Colombia, in South America. Let me just put this into full screen and let me know if you can still see it. So yeah, we're a natural gas producer focused in Colombia. We basically started this company about a year ago, in August of 2023, through the acquisition of Luis Energy Colombia. Luis Energy Colombia had been operating in Colombia for the past 17 years. And concurrently with the acquisition, we basically took the company public and listed it in the TSXV. We're also trading OTC and in Frankfurt Exchange. I think that even though we're kind of a newcomer to the public market, this company has been around for 17 years, so the operations have been around for 17 years, and it is not really a startup. We're a cash flowing business. We're expecting this year to end the year with around between $33 and $39 million in EBITDA. We have production, reserves, and so on, and we're located in a great zip code. We operate all our fields at least at a 50% working interest, but there's some that we own at 100%. And when we completed this acquisition, we raised about $70 million in debt from Macquarie Capital, the Australian bank. But very differently to most of our peers, we're actually amortizing debt every quarter. So basically, that is a value that gets transferred from the debt holders to the equity holders on a quarterly basis. Importantly, our cash flows are contracted. We have all our volumes contracted on a 5-year basis at very attractive prices, $7.50 on average for 2024. I mean, if you compare that to the US or international markets, we're significantly higher. Just by way of comparison, Houston Ship Channel prices were at 35 cents over the past weekend, and we're selling here at $7.50. And not only this year, but we have prices contracted out for, until 2028. Importantly, we are super efficient in terms of operations since we're selling at the wellhead, so we sell directly into the line at the city gate. So our OPEX is really around 40 cents, which basically translates into a net back of $5.45. Which is what underpins our expectation that this year will generate between $33 to $39 million in EBITDA. We have a reserve life that is higher than most of our peers at 7.9 years. And when you look at the PV10 of our assets on an after-tax basis, basically the value of those assets is around 88 cents. Today, our stock price is around 20 cents. So, similar, I kind of reiterate the comments that were expressed by my colleague who was just presenting that, we're very attractively valued relative to where the underlying value of the assets is. So as I was saying, we have 155 million shares outstanding. Our market cap is around $25 million. Most of if you look at the value of our assets, it's around 88 cents. Most of our research analyst targets are between 75 to 90 cents. So it gives you an idea. Insider ownership in the company is greater than 50%. And, net debt by the end of the year should be around $55 million. So all in, our enterprise value is around $81 million. Our production is on a net basis is 19 million cubic feet a day. Again, we own 50% of 38 million cubic feet a day that get produced on a daily basis for a field on a gross basis. The 2P before tax PV10 of the company is $300 million. Again, contrast that to the $81 million in enterprise value today. And our 2P reserve index is 14 years, which again is significantly greater than most of our peers. We have a massive gross acreage position of 100,000 acres. So far, we have only affected or are producing out of 2% of that acreage. So we still have a lot of runway and room to grow. And historically, our reserves replacement ratio has been, over the past 3 years, has been around 266%. We're currently covered by Canaccord Genuity and 8 Capital. So as I mentioned before, we went public last year, through an RTO in the TSXV. I think some of the attributes of this story, I'll say, are the following. It's basically a fairly de-risked story in the sense that it's assets that produce steadily. We have a strategy of producing our wells on a very tight choke to maintain a production plateau for a period of time. We have contracted volumes 5 years out. We have low OpEx. We sell directly at the wellhead. We don't have any transportation costs. And importantly, and I'll touch on this in a few minutes, natural gas demand in Colombia is higher than supply. Hence, we're enjoying a very prime moment in terms of natural gas environment in Colombia. And one thing that is important for me to mention is that the company is vertically integrated, so different to most producers who actually own our own equipment. So we own our own drilling rigs, workover rigs, as well as yellow iron, which basically gives us control over CapEx and importantly, control over our drilling program. And I think basically the story here, and we'll go through the background of everyone that's involved here in a second, the formation of this company really creates an opportunity to basically put together two teams, a very strong operating team that is running the company, as well as a team of people that has a lot of experience in capital markets and M&A transactions, which basically gives us the opportunity not only to grow organically through the development of our portfolio, but also through the development of our, inorganic opportunities, as long as obviously they are accreted on a debt-adjusted basis, right? So just a quick overview of our blocks. We have 5 blocks in Colombia today. Our blocks are located in a very nice zip code, which is close to Barranquilla on the northern part of Colombia, right on the Caribbean Sea. Our producing blocks is this one, Sino San Jacinto 1. As you can tell, there's 2 additional blocks which are contiguous to this one, but the main producing block is this one. The other thing that is important to mention about this is that this is a very strong center of demand, industrial demand and residential demand. We're located basically close to 40 minutes away from the city of Barranquilla, an hour and a half away from the city of Santa Marta, and an hour away from the city of Cartagena. And on top of that, the pipelines basically go through all of our blocks. So we're basically any future drilling will get connected to our system almost immediately. Okay. So this big block here is 226,000 acres. This is the one that is producing today. In addition to that, we have near-term development blocks, which is basically Perdices, which is contiguous here, which already has a discovery, and the VIM 41 block, which already also has a discovery, and we should be able, or we are aiming to basically develop this block and do a re-entry next year. And then we have 2 exploration blocks, which is the Sino San Jacinto 3-1, which is again same geological trend as the one discovered on Sino San Jacinto 1 and Perdices. And then VIM 42, which is a block that has an odd shape, and you see this white space here, that's a block that is producing today. So even though it is an exploration block, it's really not, greenfield, so to speak, in the strict term of the word, exploration block, because there's properties inside the block that are already producing, that are actually, this block is owned by our partner, which is SOCOL, which is the National Oil Company of Colombia, or a subsidiary of the National Oil Company of Colombia. I'm the chairman and CEO of the company. In addition to that, we have, deep bench of expertise within the company. In terms of the board of directors, we have Jeff Agosta, who used to be the CFO of Devon Energy. I'm sure a lot of you have heard about the company, $30 billion plus US and international company. He retired from Devon in 2012, and since then he went on to work with American Energy Partners, and after that he with Over McClendon, and then after that he joined Toggle Operating, which was a Marcellus Shale operator, which got sold 2 years ago for $5 billion. You have Michael Gallego, who was our chief legal officer, who's again had a lot of experience in previous companies like Frontera and Pacific Rubiales and some mining ventures, and has taken a number of companies public. Al Holcomb and Stan Jumper, who are basically the representatives of our largest shareholder, and also our technical director, Stan Jumper, but he's also a director of the company. They work with Lewis Energy Group, which is basically our largest shareholder. They own around 40%. And Lewis Energy Group is basically the third largest natural gas producer in the state of Texas. They have been with the company for 40 years. And, this guy here has drilled approximately 3,000 wells over the course of his career. Then you have Angel Roa, who's our CFO. He's ex-VP, and I've known him for past 20 years. Great track record. And Nicolas Siperovich, who's basically ex-Plus Petrol and ex-Repsol, and he's our Chief Operating Officer. So going into the crux of the investment thesis, now you know the team, now you know kind of the high-level story. But now I'll go into the fundamentals of the story. Basically, Colombia, the short story here is Colombia today is operating at a deficit in terms of natural gas demand. The country produces around 1.2 BCF a day and consumes around 1.2 BCF a day. But as of today, it finally reached that point in which supply is smaller than demand. Obviously, that has a good impact on prices. Also, it's important to mention that there's very limited regasification capacity, and hence, we're in a premier situation, basically, to accelerate the development of our assets and be able to generate a lot of cash flows and long-term contracts, right? Because all of this, basically, when demand is higher than supply, guess what? Prices are high. In terms of our main producing field, this is the Bullerengue field, which is located in the Sinu San Jacinto 1 block, the one that I mentioned that was close to Barranquilla and Cartagena. Just check here to see how am I doing on time. Okay. Our gross production from that field is 38 million cubic feet a day. It's 95% natural gas. Our strategy is very different to our peers in the sense that we try to choke back wells to ensure that water doesn't encroach into the production stream, and basically keep water at bay and make sure that we have a production plateau for a long period of time. We have no transportation costs because we sell directly at the wellhead. Our netbacks are high. We have only drilled one well since we took over, and now we're starting our workover campaign just a couple of weeks ago. And we're starting our drilling campaign on the second half of the year, which is what should drive the growth in our EBITDA. This is a track record of the field. This is a field that has been very novel, so to speak. This was a frontier basin, and no one was producing in this part of the country. And Lewis Energy picked up these blocks in 2016, and they only were able to develop them until 2018. But you can see the track record of basically increasing production. This is a block, as you can tell here, that is basically has a number of compartments. And that's the beauty of it, that we have only been producing from the eastern side of the compartment, and now we're basically starting to develop this part, and hopefully this part to basically add further locations and basically almost increase production and reserves, right? In terms of guidance for this year, our guidance is to grow between 40 to 44 million cubic feet a day. Out of that, that's gross, right? So 50% of that is ours. On a net basis, it's 18 million cubic feet a day that we have contracted, which is basically all of our production for this year. It's 93 to 95% natural gas. We also produce some condensates, which is 60 degrees API. Our weighted average contract price is $7.50. But as you go into 2025, 26, 27, and 28, our average contracted price grows because, contracts further out have higher prices, and some of the legacy contracts start tapering off, which have lower prices. Our expected EBITDA this year is around $33 to $39 million, and our CapEx is around 10 to 12. Again, what's really important here is that we are the owners of our own drilling rig. So basically, we have a lot of control over at least 50% of the CapEx, and this CapEx is net to us. The other 50% is paid by our partner. As I mentioned a few slides ago, we're repaying debt and amortizing debt on a quarterly basis, and we expect to amortize around $12 million this year. In terms of value for our reserves and our assets, this, I think, is the crux of the story, right? When you look at, first of all, when you look at our reserve life, it's way longer than any of our peers. And then importantly, when you look at the underlying value of the assets, our reserves are certified by the Golden & Mark Norton, which is a very well-known and internationally renowned reserves auditor. And when you look at the value on an after-tax basis of our 1P reserves, we're talking about $1.11. That contrasts basically with our current share price today of 25 cents, which, as I was mentioning before, should be, it's deeply undervalued. I know a lot of people talk about ESG, but really the work that the company has done on ESG has been remarkable in terms of emissions reductions, as well as our commitment to do reforesting in the areas that we own. In addition to that, our social programs have touched the lives of a large number of people, like around 19,000 students and 800 teachers in the area. In the areas in which we operate, we have multiple social programs that have been super impactful and well received by the community. And needless to say, you can see with the bench, the bench of expertise and experience that we have on the board of directors, that there's a lot of focus on basically on governance, right? Just by way of background, and probably should have started there with this at the beginning of the presentation. Before operating this company and becoming the chairman and CEO of the company, I was an investment banker for the past 20 years. I was the head of energy investment banking for Latin America and all global oilfield services at Bank of America. And before that, I was at Citigroup, and I started my career with BP. So that, similarly to some of the other board members, we have all worked at blue chip companies in corporate positions, senior positions, and, governance is a key priority for all of us. So just to summarize, why you should look at this. One is, needless to say, we do believe that the company is massively undervalued relative to the underlying value of the assets, but this is an asset base that has low decline and is cash flow generating in order, sufficient to pay our CapEx and be self-funded in terms of CapEx and debt repayment. We have a high quality and experienced management team and technical team, and we have laid out a very defined path to grow. The good thing is that we have plenty of opportunities to drill and develop in our portfolio. Again, we have only affected 2% of our blocks. And we have multiple low-risk opportunities. As I mentioned before, the beauty of our assets is that it's all, when you look at the blocks, you see that you have the Perdices block, the Sino San Jacinto one, which is the one that is producing, Sino San Jacinto 3-1. So it's all the same geological trend. So to a certain degree is about repeating what the company has been doing and using this platform to consolidate other assets in the region. And with that, I'll open the floor to questions. Sorry, Matthias, I'm not sure. Okay, perfect.
I'm sorry, my camera seems to not work for a second. So
yeah.
So far there are no questions in the chat, but I have already a couple. So
okay.
Given the current global shift towards renewable energies, how do you envision LNG Energy's group role in this transition over the next decade? What strategic initiatives are in place to align with this shift?
Yes, absolutely. So, I mean, listen, I think natural gas is a transition fuel, to be honest. And, I think it's been widely recognized by a lot of the senior leaders and industry leaders as such. So we're well positioned in that regard. It's a clean fuel, and it's the future, I think. Attending CERAWeek about a month ago, I think that the theme was about energy addition, clean energy addition, so either using renewables and so on to add to the growing energy demand, but that natural gas is basically the key transition fuel to drive the future. So we're gladly positioned in that regard, very well positioned.
And how does the company plan to navigate the volatility in natural gas prices? What measures are in place to mitigate risk associated with price fluctuations?
Yeah, so that's the beauty of the market in Colombia, that the price really doesn't fluctuate that much. If you look historically, the lowest I've seen prices in Colombia is $5, and now we're seeing prices, even some spot sales, being carried at $10. So relative, we're a bit decoupled from international markets because the country, again, has limited regasification facilities, no pipelines connecting into the country. So we're basically the only game in town in terms of developing and supplying and the natural gas demand, or satisfying the natural gas demand. So we're really not subject to any price volatility. And on top of that, our strategy was to basically, for lack of a better term, hedge our volumes for the next 5 years by putting in place long-term contracts.
And you already touched on that, the stakeholder engagement. How does LNG Energy Group manage its relationship with local communities and government or other stakeholders in its operating region?
Yeah, no, so we have an amazing social and HSE teams, both both teams, social and HSE. We really are conscious about the importance of having a strong license to operate, right? In the sense of having a strong engagement. So we have educational programs, we have health programs, and on top of that, we hire people from the local communities, from the Savannah Larga communities and the areas in which we operate. So we're very conscious about making sure that it's not only us producing the resources of the area, but also making sure that the wealth is shared with the local communities, right?
Okay. And again, in terms of risk management, what are the most significant risks facing LNG Energy Group in the current geopolitical and economic climate?
I'll say, I mean, I don't know if many of you have followed the headlines about Colombia, but there was some noise at the beginning of the Petro presidency around limiting future exploration for oil and gas and the mining sector and so on. The reality is that what that refers to is the limitation of future license rounds to provide with new exploration blocks. Anyone that already has legacy exploration blocks, and we have 4 of them or 3 of them, depending on how you want to look at it, or areas to develop, it still can carry out, their expected work program. So there's no real limitation. And in a context of, growing demand and supply that is not able to meet demand, high prices, low OPEX, cash flow generation, we are very, very much incented to basically to try and develop and drill as much as we can, as quickly as we can, so that we can place those molecules in the market and generate a ton of cash flow, basically.
And what specific markets or regions are you targeting for expansions over the next 5 years? And what focus makes these markets attractive to your company?
Hello?
Hello?
Yeah, hello. I lost you on the last part of the question.
What specific markets or regions are you targeting for expansion over the next 5 years? And what factors make these markets attractive to LNG Energy Group?
Absolutely. So, I mean, our core strength is the Americas. So we're definitely focusing in the Americas. And I would say that's, in my opinion, is basically between the US to Argentina, right? I start by looking at the rocks and first of all, playing to our core competencies, which are basically the ability to find and develop effectively and efficiently and rapidly energy resources, so natural gas, oil and gas, oil and so on. So, taking into consideration our core competencies and the platform that we have established, our focus is really now rocks. So we go after countries that have good rocks, countries like I mean, I would say US is needless to say of interest, but I think that's more of a long term because it's a very crowded market and that it's changing rapidly in terms of M&A. But our focus is really Spanish-speaking countries like Mexico, Brazil, Colombia, needless to say, Argentina and Brazil, and even Venezuela, right? So we're looking for sizable opportunities that allow us to generate cash flows. And we have a counter-cyclical mentality. You know, we don't go into places where the upside is already realized. You know, we don't want to buy high and sell low. We want to buy low and sell high. So obviously there's got to be some disconnect or rare hair on any given opportunity for us to be able to go after it. And where, you know, we have the mentality that there's two types of people, problem makers and problem solvers. And, you know, we'd rather be the latter.
Excellent. And in terms of capital allocation, how does LNG Energy Group prioritize its capital allocation, especially between exploration, acquisition, and return value to shareholders?
Yes. So it's a good question. I mean, our main focus is on, first of all, maintaining and sustaining our production base. That is really workovers and maintenance, but it's the smallest proportion of our budget. The biggest proportion of our budget is basically a sort of low risk development opportunities. So inside our fields, looking for those opportunities that will just develop some of the resources that we have already identified by drilling, you know, sort of infill drilling and so on. And then the third component is exploration, which I would rank as kind of second to, you know, development drilling, so to speak. So.
And looking towards the future, what are LNG Energy Group's long-term objectives for the next 10 to 20 years, and how does the company plan to achieve these goals?
Well, I mean, good question. I mean, I hope this becomes a multi-billion-dollar company. To be honest with you, we're here not for the short run and to flip this company. We're here to really grow a business and basically further the legacy of Rod Lewis, the founder of this company, in the sense of building this company beyond what it is today. And in order to do that, I think we'll have plenty of room to develop our portfolio and, you know, in Colombia, at least deliver $150 to $200 million in EBITDA in 5 years or by 2028. And hopefully we can complement that with some smart acquisitions, either in Colombia or across the region that can help us sort of energize and add some turbocharge the portfolio, so to speak.
Mm-hmm. And maybe one last question regarding technology partnerships. Are there any strategic partnerships with technology firms or research institutions that LNG Energy Group is currently leveraging to enhance its operational capabilities?
Yeah, absolutely. So yeah, good question. I mean, listen, our main partners in this business, to be honest with you, are the likes of some of our main suppliers, you know, like the Schlumbergers, Halliburtons, Baker Hughes, and Weatherfords, right, of the world. Those guys, I mean, on top of having been my former clients in my sort of previous life, they're leaders in technology, but importantly, we do engage with some of the local universities to use their talent in order to basically further some of the initiatives. But you know, we're thinking about the electrification of our fields in terms of using more solar or using electric vehicles, for instance. Even our rigs, we're thinking about making them at least hybrid and so on. So we're thinking ahead, so to speak, and trying to be in tune with the global trends.
Excellent. So looking at the time, we just hit the finishing line on time perfectly. So Pablo, thank you very much.
Oh, thank you very much to everyone, and hope you have a great rest of your afternoon.